Welcome to Retire Smart Maryland. My name is Cynthia DeFazio, and I'm joined today by Prashant Sabapathy and Ozy Koolagel of Elite Income Advisors. We're talking about something important in this very first segment. We're going to talk about market volatility. So viewers, don't go anywhere. Prashant, how are you today?
I am doing great. Thanks. How are you?
I am fantastic. Thank you so much. It's so good to see you. And Ozy, how are you?
I'm doing great. Thank you.
Good. I always love having you both in the studio. You always bring such a breath of fresh air and so much energy to the set. So I'm so excited. Well, today's topic, of course, the first segment, something that's not really exciting, but also it's scary, right? Let's talk about choppy markets, market volatility. Prashant, what are people thinking and feeling when we're getting into those choppy, unknown waters?
It's a scary thing to go through, quite frankly, right? You see markets always go up and down, but when we get used to markets going up, it almost creates what I would call a false sense of security, right?
Sure.
We just see our balances continue to increase and increase and increase. And that feels great while it's happening, but we oftentimes forget about the other side of the equation. And I think that's an issue. It's an issue because we're out of touch as a society in terms of how we feel about taking risk with our money. So often we ask the folks that come in to visit with us, how much could you lose before you begin to feel uncomfortable? And so many people have never been asked that question before, and so many people have never thought about what that answer should look like or how you even go about getting to that answer. And I think part of that is the complacency surrounding when markets go up and you see your balance continue to go up. It's hard to think about the idea of de-risking your portfolio. So look, market volatility is always going to be there. We have about 100 years of market history that we can fall back on to determine what markets are going to do. Now, we can't do it with exact certainty, but trend following is a thing. And so when market volatility happens, how are you going to deal with it? I mean, it will happen. How will you respond is the biggest question.
Oh, I'm going to call you. I mean, it's
great answer.
That's how I'm going to respond. That was easy. Well, let's talk a little bit. You also talk about financial education as being a very key component overall. So how wise is it to be involved, mentally in the market, just keeping up to date with what's going on? Financial education. Ozy?
I think it's really important. Most of the time the people do not realize how to even look at the statements and what they see in the statements. Like, we ask these questions a lot, like, what Prashant just said, like, the market is going to go up and down. And back in the days when you are working, when the market, went down in the 2000, went down in the 2008, and the 2020 COVID happened, guess what you had? You had time to recover that.
Yeah.
So all we have to do to explain it to the people, you had time before. Right now, in this stage of your life, you are in the distribution mode.
Yes.
And I don't think you should be putting a lot of money into the risk when the market is going to go up and down and you're going to lose some of your money. You just need to make sure that you understand how much risk you're taking it and what is the reward. Like, do you take a lot of risk to get a reward? Is it high enough? Or, would you rather to take also a less risk? It's not the reward higher, but at least you don't lose much.
Yeah.
True.
And I think going back to the financial education part of it, you also have to understand how markets trade differently today than they did 25 or 30 years ago. I mean, we used to have to call trades into your broker on Wall Street to buy a stock, right? Today, you can click a button on your smartphone and you can purchase thousands of shares of stock in what feels like a millisecond, right?
That's true.
And so information passes much more freely today than it ever has before, and that has some influence on markets, right? On market volatility. And so understanding how the market works, what drives the market is a really important part of the process when educating yourself. The other thing is understanding regulation is really important in this day and age. I mean, so much has changed with politics and regulators in terms of what kind of laws you have to be staying abreast of. And so, look, what we found is that for most people, they already have a full-time job, and to explore and educate on all the other things that you have to learn in order to retire properly, it almost feels like another full-time job. And that's why we believe that you should partner with a specialist who can help you through that. But everybody should always be trying to learn as much as they can to educate themselves about the process, without question.
And when it comes to education, I just want to point out, because sometimes the people comes in and it says like, oh, my neighbor done great, with investing in this stock and that stock, I'm just going to follow him. It's just, again, not everyone's situation is the same. Maybe your neighbor has a great pension and the Social Security, and that's a good enough money for him to live off.
Yeah.
In the meantime, you need to take money out from your accounts to live off. It's just like, you just need to ask for professional help.
That's true. That's true. Thank you, Ozzy. What about the importance of diversification? Prashant, is it important to be diversified when the market's going up and down?
I think it's incredibly important, but diversification means different things to different people. I can't tell you how many times people come in to visit and we look at their portfolio and they think that they're diversified because they have 30 or 40 or 50 different stocks and mutual funds and exchange traded funds in the portfolio. And one of the things that we do is something called a correlation analysis. So the correlation analysis will show us how much overlap each one of those funds has. And so it's interesting. You could have 40 or 50 different investments in your portfolio, but if they're all correlated, meaning they all go up or down the same type of way, you're not truly diversified. So what diversification means to us is having a combination of investments that truly allows you to mitigate risk in a non-correlated way. That's number one. Number two is the importance of diversifying your taxes, okay? Having money in pre-tax retirement accounts, tax-free retirement accounts like Roth IRAs, and even after-tax accounts provides you with tax diversification as well, which is so important. And number three is diversification of management style. So think about this. If you had one money manager managing all your money, what happens is you're immediately in a position where if this money manager gets it right, you'll be successful. But if they get it wrong, you're going to have an issue. And so one of the things we talk about with our clients is this idea of diversifying the money management process. Instead of hiring one money manager, does it make sense to hire 2, 3, 4 money managers? That way, not all of your eggs are in one particular basket. And that's what true diversification means to us. I'd venture to guess that most advisors out there are not talking about diversification the way that we are. And that's why we open up our calendar every single week when we do the show to give you an opportunity to come in and have a Retire Smart roadmap prepared for you. Folks, that phone number, 833-308-5200. When you come in to visit with us, we're going to help you put together that Retire Smart roadmap. It's going to include an income for life plan, help you map out your income each and every month and year for the rest of your lifetime. We'll also put together, as a part of that planning process, a risk analyzation report. It'll help you understand how much risk you're taking, whether or not your investments are truly correlated or non-correlated, which is just a function of how diversified you actually are. All of that is totally free of cost to come in and look at in our office, but it does start with you making that phone call. It's 833-308-5200, free appointments and no obligation when you come in.
Prashant, thank you so much. Ozzy, thank you so much. To our viewers at home, that number to call, 833-308-5200. You need the Retire Smart roadmap. You deserve it. You've worked your entire life to get to the retirement years. This is your opportunity to claim your spot today and grab one of those Retire Smart roadmaps. They can be drawn for you so that you can have the retirement of your dreams. Again, that number, easy to call in, 833-308-5200. Or even simpler still is to grab your smartphone, click on that QR code at the bottom corner of your screen. That will take you right to the landing page for Elite Income Advisors, and you can claim your spot accordingly so that you can have one of the Retire Smart roadmaps constructed for you. We're going to take a very short commercial break here on Retire Smart Maryland. Don't go anywhere. I have so much more with Prashant and Ozzy when we return.
I was always big on the numbers. Growing up, always had a spreadsheet, making budget. My father and my uncle, they were both kind of in the financial service industry. It's like, I love the numbers. I like helping the people.
So Ozzy and I have been working together really for 12 years now. We both worked at a big insurance company.
One day my manager came in and he introduced me to Prashant, and he said, hey, I do think that you guys might be a good match to each other. He just graduated from the school.
I think we both kind of just knew right then that it was a really good fit.
We start working together, then I found this business that was going to be up for sale. And I said, like, I'm interested. And then we get into a deal, and I asked Prashant if he wants to join, and he says, yeah, sure, why not?
We transitioned our insurance practice from the original owner who was retiring, and then we co-founded together Elite Income Advisors. What motivates me, my mom was diagnosed with frontal lobe dementia when I first started. That's kind of what gives me the passion to do what I do. I know how stressful it can be, so I've lived through not just the financial side of dealing with that, but if I can help other people, navigate some of the things that I've personally experienced.
Welcome back to Retire Smart Maryland. My name is Cynthia DeFazio, joined today by Prashant Sabapathy and Ozzie Koolhagel of Elite Income Advisors. We're talking all about what do you do with market volatility and how can you help properly be weathered in the storm, if you will. So let's talk about this next bullet point, if you don't mind. How important is it, Ozzie, to understand and manage debt? When we're talking about market volatility, how important is it to understand and manage what debt you currently have?
You don't want to have a bad debt, just for the clarification. And when we get closer to the retirement, most of our clients, they would like to pay off, their houses and the cars, and they just want to be debt free.
Sure.
And some of the people also looking at differently, they just want to have a, bigger car, better car, luxury car, having a second home and here, there. And you just need to sit down and take a look at it can I manage this debt? What is my income? How much income coming in every month and what I can afford? And what you really need to take a look at it is you don't want to spend more than what you make, and you want to try to eliminate the debts, especially getting closer to the retirement, because you want to do the things you haven't done when you are working, which most of our clients like to travel.
Yes.
You want to travel, you want to enjoy the life, but, living your means, so to speak, right?
Yeah,
sure.
That's exactly it. I mean, I think debt only becomes an issue in the absence of income.
True.
Right? And so it's all a function of just where do you want your income to go when you retire? Do you want it going to a bunch of debt that you haven't yet paid off? Or do you want it going to doing some of the things he was just talking about, traveling, spending time with your family or your grandchildren or whatever is important to you? We want to see your income going to those things, the things that are actually going to make your life fulfilling. Now, if that for you is buying a really nice car, we're okay with that. It's we always say it's your money. We're just advisors. But if that's what's important to you, you need enough income to support the debt.
Yeah.
When we don't have the income to support the debt, that's when it becomes a problem.
And sometimes what we see is some of our clients, we always tell them in our office, whenever you make a big decision, for us, the big decision is anything over $3,000. Just please give us a call. We're not your parent, but we're just a financial advisor. We would like to give our 2 cents to you. For example, the person wants to buy a car, $50,000, and he goes to a dealer and gave them a 8%. These days, the rates are 8%.
Yeah.
And in the same time, our client has $150,000 in the bank, makes no money. It doesn't make sense for that person to go buy the car with a
At
debt.
8%, yeah.
Why would you want to do that? Just go pay cash and, then you don't have a debt.
Yeah.
That's true. That's true. Excellent point. Thank you, Ozzie. Prashant, what about this next one? Harnessing the power of compounding.
Look, when markets are volatile, and they will be, you have to take advantage of that, right? So when markets go down, that is the best time to actually buy into the market, because everything we buy at the low point, when the market recovers, will be worth a heck of a lot more. So 2 points on this. Number one is automating the savings and investment process. So a great way to do that is to systematically put money away on a monthly or bi-weekly basis. That way, when markets go down, we're automatically buying into the market. And number two, if you do that for a long enough period of time, you're going to create returns on a bigger pot of investments. I mean, look, getting a 10% return on $1,000 looks a heck of a lot different than getting a 10% return on $10,000. Looks a heck of a lot different than getting a 10% return on $1 million, right?
True.
But returns come and go. Markets go up and down. The best thing you can do is just automate the process and take advantage of that compounding over a long period of time by taking the decision-making process off your plate. Every time you get paid, invest part of that money. Take 10 or 15% and buy in to a set of investments, dollar cost average. And in my opinion, if you do that for a long enough period of time, it allows you to build up the type of nest egg that you're going to need to recreate the paycheck that you want to get to when you retire.
Prashant, thank you. Ozzy, what about this next one? Creating multiple streams of income. And we've talked about this, about having different buckets, but let's talk about the multiple streams of income to help offset market volatility.
Yes, like, Prashant touched on this earlier, that, you don't want to put all eggs in one basket, right? We would like to have different places of income coming in from different sources also. Like we have the market money, if we need to take money out, we can take it out, but you don't want to take money out when the market is down because, your account value goes down a lot. Then you have, guaranteed income streams that is bringing you money for the sum of the sources that you need. And most of our clients also relying on the real estate is the same thing.
Yeah.
It's a different type of asset. You just would like to have more than 2-3 different places that you can rely on to get income out of it.
And honestly, when you have multiple sources of income, it takes the stress of the stress of potentially one of those income sources being jeopardized. It takes a lot of that stress off your plate when you're not depending all on one source of income, right? And so I think that's a big deal. I had a client come in recently and ask me about using dividend stocks for income in retirement. I said, that could be a good idea. I mean, it could be if you're working with quality companies and they pay a dividend. But I was talking to him and I said, what happens if, stock price hypothetically is $100 a share, paying you a 4% dividend, and now they're still going to pay that 4%, but the stock price goes down from $100 down to $90 a share, right? What's going to happen? If they keep it at just a 4% dividend, the value of your income has gone down now.
Absolutely.
He said, oh, you know what? I never thought about that. I just thought that because they've paid a dividend that they would always do that. Dividends are non-guaranteed. If you pull out a prospectus on any mutual fund or anything like that, you will see that dividends are non-guaranteed. Find me a company that's going to guarantee a dividend payment every single month, every single quarter.
It doesn't exist.
It doesn't typically exist. So diversifying your income streams, have multiple sources of income. Maybe you can have sources of income that are non-guaranteed, but you should also have sources of income that are 100% guaranteed. And that's what privatizing your pension can do for you. And look, Cynthia, I think where it starts is this idea of setting clear-cut financial goals.
Yes.
And so I want to talk a little bit more about this on the other side of the break. But look, if you haven't diversified your income streams, if you haven't done a real portfolio analysis, now is a great time to do that, folks. The market will be volatile over the next months and years. I mean, we are in an election year as well, which tends to create a little bit more uncertainty. The best thing you can do is figure out where you stand today and whether or not you're on the right track. We'll help you do that, but you have to do your part. Pick up the phone, give us a call, 833-308-5200. We will help you map out your income, understand your risk, and we still have to talk about taxes. When taxes go up in the future, how will that erode your purchasing power and your ability to draw income from your portfolio? These are all the things that go into having a solid distribution plan. It starts with that phone call for your free appointment with our team of specialists at Elite Income Advisors. We have offices in Ellicott City and Annapolis, conveniently located for you to come in and take a second look at your retirement plan. 833-308-5200.
Prashant, thank you so much. Ozzy, thank you so much. To the viewers at home, the number to call is 833-308-5200. If you don't have your pen handy, that's okay. Grab your smartphone, click on that QR code at the bottom corner of your screen. That will take you right to the landing page for Elite Income Advisors, and you can claim your spot accordingly. We're going to take a very short commercial break. When we come back, we're going to talk more about the specifics on setting your retirement, your financial goals, if you will. So stay tuned. Don't go anywhere. We have so much more when we return.
Do you have the answers to these 4 key retirement questions? How much should you save each year for retirement? How much do you need to have saved in order to retire? What will your retirement savings cover? How can you make your retirement savings last the rest of your life? We'll cover all of this and more by building you a complimentary retirement roadmap. Just visit retiremaryland.com today, and you'll also receive a complimentary copy of my book, Fiscal Health, Retirement Wealth.
Welcome back to Retire Smart Maryland. My name is Cynthia DeFazio, joined today by Prashant Sabapathy and Ozzie Coolhagel of Elite Income Advisors. We're talking all about your retirement years. So, Prashant and Ozzie, you brought up a very good point, talking about specifics on setting retirement goals. Let's dive into that. Why is that important?
It's important because unless you have a clear-cut objective, you can't really put together a specific laser-focused retirement plan. I mean, if you're going and meeting with an advisor and they're just kind of managing your money, what are you actually working towards? I mean, of course, we want our money to grow, but what do we want to actually accomplish down the road? So this is kind of interesting. Cynthia, have you ever been to London before?
Yes.
You have. And
yes.
Oz, for the audience that doesn't know that, Oz, you went to school at London School of Economics, right?
So I lived there a couple of years.
Okay, so he lived there a couple of years. He has a PhD.
Nice.
He's very modest about it. But look, one thing that we know about London is you've been on London Underground, right? Mm-hmm. So 1969 on the London Underground, you know what they started printing on the ground on the London Underground?
No.
They started printing "Mind the Gap," okay? And that's what is kind of famous. And the reason that they put "Mind the Gap" on the ground is people were not minding the gap between the platform and actual the train cars, right? And so the way I look at it is people in Baltimore, people in DC are now transitioning where they're crossing this gap from their working life into that moving train car of retirement.
Yes.
And we have to talk about minding that gap. And so let me relate this back to setting clear financial goals, right?
Okay.
So you come in, visit with us. One of the first things we're going to talk about is what is your monthly income target? Okay, I need $7,500 a month. Let's say that you need $7,500 a month in order for you to retire the way that you want to in retirement. Now, you total up all your sources of Social Security, pensions, if you're fortunate enough to have one. After tax, the average American family brings home about $2,500 of Social Security payments. Okay. So I need $7,500 a month after tax. I have $2,500 a month coming in. And this $5,000 a month gap is the gap that we have to mind as we're making that transition into retirement.
Okay.
So the $1 million question for retirees is, how do I reliably fill in that $5,000 a month gap or $60,000 a year in order for me to retire? Well, look, if the market keeps going up each and every year for the rest of my lifetime, and I have $1 million or $2 million, closing a $5,000 a month gap is not actually that difficult. The problem is, do markets ever just go straight up?
Right.
They go straight up until they don't, right? And then they go down really quickly.
Right.
So this is where bucketing your money can help you mind that gap in your income. You have $2 million and you're 5 years away from retirement. Does it make sense to take $500,000, just a quarter of your investment, and use it to create a guaranteed stream of income? I actually ran a report on this before we came on to do the show. What I found with a 60-year-old person with a 65-year-old spouse, 5 years away from retirement, if I took $500,000, put it in a safe and secure account that generated a pension income for them, 5 years after getting into that account, it would provide $48,000 a year of reliable income every single month, every single year, for the rest of both spouses' lifetimes.
Wow.
And that is what I call income security. Okay?
Absolutely.
If we need to figure out how to mind the retirement income gap, a great way to do it is to actually go to some of the oldest institutions in America and explore the use of fixed indexed annuities. I can't tell you how often people come in and they say to me, where's my paycheck going to come from?
Yes.
And oftentimes using these newer indexed annuities that guarantee you income payments for the rest of your lifetime are oftentimes the most powerful thing we can do to shore up your income security. And when you have income security, what does it allow you to do? It allows you to invest the rest of your money in such a way where you can get a sustainable return without having to access that money through a volatile market. It's just a more efficient way of planning. And unfortunately, I think most advisors in this day and age are not using these solutions. And I think it's just a better way of doing things, in our opinion.
Yes, and allows you to sleep well at night.
Absolutely.
Can we talk about this one?
Yep.
Sleep well at night, and it's so true because you're giving people the gift of peace of mind in their retirement years. They don't have to wonder, they don't have to stress. It's basically guardrails, so no matter what happens, they're going to stay on the right path.
Yeah, that's exactly it. And you know, Oz, you talk with clients about this type of thing all the time. Is look, retirement is not that difficult. It's just about figuring out how to recreate your paycheck, right? Like when people come in to visit, like with you, what are their income targets looking like? Are people okay just saying, I want 50% of my income in retirement?
I never seen that.
Yeah.
Well, you know, all the time when the people comes in our office, we have a software and we put the numbers in there. How much you're making it right now, how much you're spending it, and most of them are saving money. Then when we look at it, I want $7,500 coming in. Okay, how much do you want at your retirement? Everybody says, I want the same amount of income.
Yeah.
So going back to what Prashant said, if $2,500 is coming from the Social Security, there is a $5,000 gap. How are we going to close this gap?
Yep.
Because the people care about their paychecks. People care about their income.
And
Yes.
last thing on this is 20 years into your retirement, that $5,000 a month that you're going to need, even if we just use a 3.9% rate of inflation, you're going to need closer to like $130,000 a year of income for it to feel like the $60,000 that you need in today's dollars.
Wow.
So not only where is your income going to come from, but is it actually going to keep up with the cost of living?
Yeah.
Folks, if you haven't done that work to figure out whether or not your paycheck is going to keep up with inflation and be enough for you to retire comfortably, give us a call. Last opportunity for today's show, 833-308-5200, totally free appointment with our team of retirement specialists.
Prashant and Ozer, thank you so much. To our viewers at home, thank you for spending time with us today on Retire Smart Maryland. Be safe, be happy, be blessed. We'll see you back 1 week from today. Take care now.